Hi, everyone. This is Jason Burek of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. The gold and silver prices, they've corrected a little bit, but gold has rallied back above 2,400. It's at $2,430. Silver is not as high as gold. It's still above 25 at $27.44. I wanted to get a gold and silver expert on to talk about the Q2 2024 earnings for the gold and silver miners, and then also about like juniors, if they're able to raise capital or build mines. He wrote a book a number of years ago. The book is How to Invest in Gold and Silver, a complete guide with focus on mining stocks. And he also has the website Gold Stock Data, which is an extensive database for a reasonable price that just tracks an insane amount of information about all the things you want to know about the individual mines, the mining companies. Don Durrett, thank you for joining me.
Hey, Jason, thanks for having me back. It's been too long. Yeah, absolutely. The book, I've updated it like 9 times. I came out in 2012, I think. I keep updating it, keeping it up to date, but it's basically a textbook on how to analyze gold miners. So anybody, and I don't think there's anything else out there that's like it. So if you own any gold and silver mining stocks and you're not an expert, you want to read that book.
Actually, Don, I think as soon as the book came out, I think I interviewed you. Gold and silver miners, as you're well aware, were in a bear market for so long that they were just cheap and hated and cheap and hated. I mean, you've been around so long, as long as I have. Back in 2015, I mean, literally, I'm sure you were getting phone calls and emails about Silver Wheaton failing, Pan American Silver failing, going bankrupt. That's not the case right now, but the sentiment is not exactly great either, despite relatively high metals prices.
Yeah, sentiment has not improved yet. We got the gold miner premiums. I actually did it today. I ran the cost. The break-even cost for gold miners is $1,850 right now. So that would put the ASIC around $1,550. So it just keeps going up. But the margins right now for the gold miners is about 24%. And that's basically healthy for gold miners, right on, I would say, below 20% is not good. 20 is about marginal. 24, 25, it's pretty good. We need to get about 30% premium margins, excuse me, and that's when sentiment will improve. Now, for silver miners, it's absolutely pathetic. We have a margin right now. The break even is about 26, so about $22 ASIC average. So the margin is $5 right now, 5%, excuse me, and that's unhealthy. So the silver miners are really cheap. As a matter of fact, the only silver miner right now, producer that's not cheap, is Gatos. Everything else is on sale because of these margins. The margins are so low. It's hard for these companies to generate a lot of free cash flow. And so that needs to improve. So for sentiment to improve, we got to get above $2,500 gold. That if you do an NSR, GSR, excuse me, gold silver ratio of 70, that takes silver to 35. So I think that if we get gold above 2,500, I think silver will rip from where it's at now, about 2,750, all the way to 35 in like a month. It won't take long. It'll rip faces off, as Rick Rule likes to say. That's my expectation.
And like I said, we're recording this interview on Friday, August 9th, 2024. We've had the gold and silver miners report Q2 quarterly earnings in the last couple of weeks. I think, Don, one of the trends that we're starting to see is that, yes, the miners have good profit margins, but the costs are still trending up unexpectedly. We're starting to still seeing rising input costs, whether that's labor cost of capital up, energy costs, ore grades falling. Even Newmont Mining, which has been telling investors in their investors presentations that they're going to sell the higher cost mines, they're going to liquidate those for cash, and they're going to focus on low cost mines. And the goal is to get the cost back down to around 1,200 by 2028. Their recent quarterly earnings, their costs were up a substantial amount. I don't know if it was $100, but it was close to $100 cost increase. And I think it's still around 1,600 for their cost. So they're still trending up. And then you even told me before we started recording, you said even Agnico Eagle, which is considered like the gem and people pay a premium for those two high-grade, low-cost, amazing mines in Canada and Canadian Malartic and Detour Lake. You said their costs are even up substantially in the last earnings call.
Yeah, up $100. They were a low-cost miner, ASIC about $1,150, but now they jumped to $1,250. $1,250 is kind of the upper range of a low-cost producer. But yeah, Newmont and Barrick, they've been having trouble containing their cost. Newmont right now, I have their break even at 1,800. That's for they had much better margins. They're no longer a low cost producer, and They think they're going to get their cost down to 1,200. I think that's their ASIC. So their ASIC right now is about 1,500. Yeah, I don't think they're going to drop $300. They're lucky if they get it down 150. But if copper prices go up, that'll help them. They use the copper for offsets. But yeah, Barrick and Newmont, you have a decent margin at 1,800 if silver prices stay high, about 25% somewhere there. Not a terrible margin when you're mining 6 million ounces of gold. But the thing that's nice about Newmont is, they have a ton of leverage as the price of gold goes higher. So if their margins get to 30%, even though they have high costs today, if gold can rise faster than cost, hopefully that'll be the case, then Newmont could do well. I have them right now as a 13 multiple, which, as far as I'm concerned, that's on sale. I think Newmont is a class, the reason why it doesn't have the high multiple is because their costs keep going up and investors aren't super interested in it. But I think as gold prices go up, if their margins expand a little bit, you're going to get multiple expansion. I think you're getting Newmont, maybe not half price, but I think the multiple will go to 25 and maybe higher than that as gold prices go up. Let's say gold goes to 2,600 to 2,700 by year end. So costs shouldn't shoot up between now and year end. You could get some significant multiple expansion on Newmont and Barrick. So there's that.
For multiples, for listeners out there, which multiples are you speaking about? Are you speaking about free cash flow multiple, operating
Yes.
cash flow multiple?
Free cash flow.
Okay. Just want to clarify things. Because, a lot of the industry, especially like people inside each company at the mining companies, they use like an operating cash flow multiple, or they look at net asset value, which is similar to discounted cash flow metrics.
Yeah, the industry and the companies, they don't seem to care about investors. They're like, you guys figure it out on your own. This is what we're going to give you, right? A lot of some of them will give you free cash flow, but they won't value their company on a free cash flow multiple. They will do it on like operating cash flow. But for me, there's certain data points that don't really help a lot. You got to change them, like the ASIC, the all-in sustaining cost. It's really worthless on its own. You got to pad it, and then you have to figure out how much to pad it. You got to figure out what costs are not there to get to the free cash flow. So that's what I do. I take the ASIC and I pad it. And then the operating cash flow, I mean, it's useful in the sense that it shows you they're generating cash, but how they're spending it is important. And that's kind of where the free cash flow comes in. So I like to focus on free cash flow.
So for our listeners, the ASIC that Don's referring to is all-in sustaining cost, but honestly, that's a way better number and more inclusive and more accurate than the old cash cost number, because I used to send emails to the Canadian investment bank analysts that cover these mine stocks, and the cash cost numbers were so they didn't reflect reality, that some of the mining analysts used to tell me just multiply the cash cost number by 2 or by 3. That's how inaccurate the industry was with costs. So the industry is getting better, is getting more transparent, is getting more accurate. The all-in sustaining cost number is not perfect. It's non-GAAP. But I think it does indicate a trend. So if like the company, if you go back and look at past numbers for the company and the all-in sustaining costs are trending down, that means management's doing a good job controlling costs, maybe buying better assets or more efficiencies, or they had a exploration success like Alamos Gold at an existing mine. But if the cost, like the all-in sustaining costs, keep going up and up and up, when management says, "Oh, we're going to bring costs down," I mean, you can't trust management then.
Yeah, absolutely. Yeah. ASIC definitely helps. Absolutely. Especially in the gold miners. The gold miners tend to do a pretty good job of the ASIC being fairly close to the free cash flow. The silver miners, they can be all over the place. You can have some pretty big gaps between the all-in sustaining cost and the free cash flow number. But overall, yeah, I'm glad they give us the ASIC. You're right, it is kind of a new number. And one thing I want to talk about, mention cost real quickly, that I've noticed, which is kind of a new trend, is the amount of money on top of the cash cost. You mentioned cash cost, got times it by 2 or times by 3. It's pretty interesting how, especially the gold miners, if you look at the cash cost that they're reporting, versus how much additional money it is to get to the break-even point. It's like that's how I can really get a feel for how costs have risen. It's like because it's like all this G&A stuff that's not in the cash cost that has risen as well. Now the cash cost is supposed to include all your inputs, your labor cost, your electricity costs, et cetera. So why these additional costs are increasing is a bit of a mystery to me. But the last 2 years, they've really, really kind of expanded out. It's been kind of shocking to me.
I guess there's inflation, or maybe Newmont Mining's just hiring more ESG vice presidents still.
Yeah, it's not a trend I like. It's the cost keep going up.
Well, that's the case in a lot of businesses. I mean, you can speak to people in the restaurant industry, many other businesses. All these input costs are still rising. The consumer price index in the United States, Canada, all these different countries, Europe, United Kingdom, are not reflecting reality for many business owners in many industries.
Right. Yeah, I would say that the percentage difference between the cash cost and the ASIC has increased. And that's kind of a new phenomenon.
Oh,
So
that's interesting. So I want to ask you though about low cost producers that you have. So do you consider the companies like Alamos Gold and Lundin Gold and Dundee, are these the low cost gold miners right now?
yeah, there's not that many of them left. Say with an ASIC below $1,000. But yeah, Orla Mining is a very low cost. Dundee, Lundin, Alamos. Those are some of the low cost producers. Also in West Africa, you have some companies that tend to have not high cost, like Endeavour Mining, Perseus. Those two companies tend to have fairly decent cost, especially Endeavour. And then also in Australia, Evolution Mining, Northern Star. They're not super high, but there's not very many of them left. The big miners that have like 1,000 ASIC or lower. They're becoming a small group, if you will.
Yeah, I agree that costs are trending up still, especially with falling ore grades. So major theme is rising input costs, a lot of the like labor and energy, materials costs, cost of capital, and then falling ore grades. And I don't see that trend going away.
Yeah, I used to be happy with like $1,400 ASIC, but no more. Now it's like 1,200. The reason why is, the break evens have went up a little bit. So anything that if I see any ASIC at 1,200, even 13, I'm kind of happy. And then once above 13, once you get to 14, it starts to the margins start to get squeezed a little bit. And then if you get to 16, that's when it starts to become a high cost company. And the norm is becoming more and more like Newmont's right there, right about 1550, I think, and Barrick's right about 1550. So that's kind of those used to be the bellwethers, but now they're starting to become marginally high cost miners, which I didn't think that would happen.
Well, you've seen, let me
Go
add
ahead.
to your points there. You've seen Newmont Mining and Barrick Gold add copper exposure, a lot of primary copper mines. So that's like adding costs there. So they're adding reserves in terms of gold reserves, but it's marginal production. So they're more focused on copper. But the other issue, I mean, for the industry is just falling ore grades. I was reading a Seeking Alpha article and it was congratulating, it was either Newmont Mining or Barrick Gold, I can't remember which one, over the last couple months on maintaining the same ore grade. But then over the last 3 or 4 years, so the ore grade stayed the same. Their average ore grade on all their deposits, it was around like 1.74 grams per ton or something. But what they left out, the article writer, because it was twisted, the perspective was that costs for Newmont went from like 1,100 all the way up to 1,500 before their recent quarterly announcement.
Um, yeah, absolutely. We're seeing that trend as well. My database has all of all the producers, and so I just brought it up. So we got Orla at 1,100 is the lowest cost producer. This is break even. Then you have Dundee at 1,150. Capricorn Metals in Australia 1,250. Centerra in Canada 1,300. Lundin at 1,300. Alamos at 1,350. Evolution at 1,350. Torex at 14, and that's it. After that, you got Northern Star. I mentioned them. They're at 14. So there's only about 10 of them that are under 1,400. So there's not there's not a lot to pick from as far as low cost producers anymore. So,
Do you
but as the
think
price goes up, you'll get more margins. So some of these higher cost producers will they'll still be generating a lot of free cash flow.
Do you expect a lot of mergers and acquisitions in the space? Because in the last week, there was a Bloomberg article about Australian gold miners doing mergers and acquisitions with the much higher Australian gold price. So do you expect some of the mid-tier miners like an IM Gold or Kinross or some of the other mid-tier ones to be more aggressive and start to look into Australia for mergers and acquisitions?
Yeah, this summer has been very quiet for M&A. And I think a lot of it has to do with these higher costs. And these companies, they feel like their shareholders are not going to basically be happy if they do an acquisition, have to pay a premium. It's interesting. The two mergers that happened in Australia were both mergers of equal. There was no premium. You had West Gold acquire Karora, and then Red 5 acquired Silver Lake. So four mid-tiers merged, but they didn't have any premiums. There was no premium. It was a merger of equals. It was really smart because what they did was they made their company stronger and bigger so somebody couldn't come take them over. So it was kind of it was very good for shareholders. So I'm hoping to see more. We are going to see a boatload of M&A once the sector gets healthy. And it's basically going to be open the floodgates. And I think the reason what's holding it back is we still have the risk on trade on Wall Street. So Wall Street really isn't interested yet in the miners. But I think once we start getting a break, like I think it started. We had the Monday crash this week, but then the stock market rebounded. So we've had the Bear Stearns event. We haven't had the Lehman event. So when we have the Lehman event, I think once we turn the risk off, and it's not going to completely flip the risk off, absolutely, but if the trend starts, when people start looking for gold miners and silver miners and it improves. The other thing is the silver miners. Most of these gold miners have silver mines, and so as the margins go up in the silver mines, then that will improve the M&A. And I think that M&A will explode once the silver miners become healthy, and that's going to take $35 silver. So once you get to $35 silver, I think that's when M&A is going to absolutely explode. And I created an optionality list of 50 miners, gold and silver. The gold miners, they all trade in gold. What I call an optionality is gold or silver in the ground that's valued under market prices. So my list of 50 stocks are gold miners with gold in the ground under $15 and silver under 30 cents an ounce. And there's 50 of them. There's a boatload of them. So there's a boatload of companies out there that are valued around $10 an ounce in the ground for gold. And they're fantastic projects, but they're not getting any value. At a certain point, what's going to happen is the rising tide is going to lift all boats, and most of these companies, not most is a big name, but maybe 30% of them are going to get taken out in the next 2 years, just because they're so cheap and they have good projects. A good example is Free Gold Ventures in Alaska. They're valued they have a 20 million ounce open pit. It's a single pit. It's 5 miles away from Kinross's Fort Knox mine. It's an identical mine, identical. So it's perfect for Kinross to pick up. Fort Knox has been in production since 2004. It ends in 2030. So all they have to do is move 5 miles away and bring their mill with them and bring their workforce with them. It's currently trading at $10 an ounce in the ground. And Eric Sprott owns 28%. He's not going to sell it for less than, say, 80. He probably won't sell it for less than 100. So that's basically a 10-bagger just sitting there. So the Free Gold Ventures board, they're just sitting there waiting for the M&A to kick into gear. And so once M&A kicks in, it's going to be a rising tide that lifts above. So the first deals are going to be made about $35 an ounce. Then you're going to go 50, and then it'll go 75. It'll just keep rising and rising and rising. This is the big if gold prices keep trending higher, and these trends, the margins stay at, say, 30%. We got to have high margins to drive these M&A deals. But I think but once the margins are there, I think we're going to see deal after deal. We're going to see a boat. We'll see 5 deals a month is my expectation. Normally we see 3, but lately it's been 1 or 2, which is bizarre.
I think there are some deals being worked on now, but these deals take a long time if they're sizable. So over the next 6 to 12 months, I agree with you, as long as metals prices do not crash. In terms of the big money managers that are buying gold and silver miners, I mean, the only one that I know of right now is Stanley Druckenmiller. He was buying Newmont Mining and Barrick Gold. So, and then he was looked at like he went cross-eyed or something, or he had gotten dementia, early stage dementia, when it was
Yeah.
disclosed in his filings that he had sold his Nvidia shares ahead of time and started accumulating gold miners.
Yeah, Stanley's he's the GOAT. I mean, he bought Newmont at 30 and now it's at 47. So he's up 50% in, a few months. So yeah, he's the GOAT. He can see it all coming. He's one of the guys I always listen to. But he's, like you said, he's the only one that we've really heard about on Wall Street. There's one other fund. There's a guy, Singer, Paul Singer. He basically has a fund that he said this was before, a while ago. He said he was interested in the miners, but it's been kind of under the covers kind of thing. It hasn't really been made public, but he has a big fund and we're going to see more funds get involved in this. But the one thing is, the leverage on these stocks is, especially the silver miners, is kind of unbelievable. If we do run to, let's say, an all-time high in silver, which if you adjust the 2011 high of 49 for inflation, it's $68 for silver. So that's my target for silver is 68. I think that's where we're going in this next bull run. It could be higher, but that's my minimum target. And so if you go to $68 silver and you run the math, and let's say that it happens within 12 months and the inflation rate is only, let's say, 5% on the cost, if costs only go up 5 or 10%, these stocks they're going to rip faces off it. I mean, it's going to be stunning. All the silver miners basically print crazy returns, if you will, if you go to 68. One example, the cheapest one is Avino silver. Avino, it got down to 43, and I was just telling everybody, buy this thing to the bottom. It's not. They have 350 million ounces of silver equivalent, and they're one of the few silver producers that's basically an optionality play. It's less than 50 cents an ounce in the ground. And it's a growth story on top of it. So they're producing 2.5 million ounces of silver equivalent now. They're going to add 1 million ounces next year with a capex of 10 million, and they're valued about 120 million. But it's a growth story where they're going to increase production to 8 million ounces over the next 5 years. So it's a steady growth. But the problem is, and the reason why it's not one of my favorite stocks, but I do own it. But the problem is that 80% of their shareholders is retail. And so if anybody goes in there and makes an offer, the retail investors are going to take it because they basically don't have any insiders. They don't have any institutions. There's nobody to say no. So I don't know why. Maybe there's a deal under the covers, but there's nobody's announced. I think if somebody did a hostile takeover, it would work. And I just don't understand why it hasn't happened yet. I guess because nobody's expecting silver to go higher. But once silver gets to $35, somebody's going to go after Avino. It's just too cheap. I mean, if you do the math, I mean, it literally prints as a 40 or 50 bagger. If they don't dilute any shares, and they don't need to dilute because it's a very low capex. Basically, they bought the La Precocia mine from Coeur. Coeur basically gave it to them. And then Coeur was an idiot. They basically could have owned 20% of it and just rode that 50 bagger. Instead, they took 13%. They owned 13% of this company, and then they sold their shares. They sold all 13%. Instead of doubling it, they should have doubled it to 26 instead of selling. But they're gonna, whoever buys that mine is gonna make a bunch of money.
Do you think that we're at a gold price where if it stays here for 6, 12, 18 months, that there's going to be a lot of new mines built? Or do you think that the higher interest rates, the relatively high interest rates, and the Fed hasn't cut rates yet or cut rates substantially, do you think that's preventing the mining companies, maybe these juniors that have a feasibility study, from going out and raising the capital to build a mine?
Well, the thing about development stories is it's hard to get to a construction decision. It takes a lot of work. You have to drill it out, you do the PEA, the PFS, the feasibility, and the permitting. So you have all these steps that are involved, and then you get to construction ready. There's not that many projects out there that are construction ready that are just waiting for money. You have the huge one. Bear Creek has a huge silver mine that's construction ready. And I think it's in Chile. It might be in Peru, one of those two.
You mean Corani, or are you referring
Yeah,
to
Corani. Thank you.
It's
Yeah,
more of a base metal mine, but it does have massive silver reserves. So it would need like high lead and zinc prices, I think, and nickel too.
right. But it is construction ready. I'm just thinking of ones that are construction ready where, silver prices blast off, somebody can write them a check, but there's not that many. Another one is Vista Gold. They're construction ready, and nobody wants to build it. It's an economic, but it's a big one. That really is a kind of an indicator that what you just said. If the price of gold stays here, I think if the price of gold stays at 2,400 and doesn't go below 2,400, I think somebody will build that Vista mine, because it's totally economic at 2,400. It's economic at 2,200. Somebody will. But my point is it takes a long time. There's a lot of development projects out there right now, probably 100 of them, but there's only probably 5 that can get to construction ready within, say, a year. I mean, even if the prices go up. So you're not going to see this big, building boom where you have all these mines come online, because you have to get to construction ready, and it's not easy. You have to basically permit these things out. I think Maritime could get to construction ready within 6 months. There's several of these projects that are 6 months, a year away from construction ready. I think Silver Tiger is getting close. It's a silver mine. If I did some research, I could definitely come up with probably 10. There's probably 10 developments between gold and silver that could get to construction ready within a year. But everything else.
Are those single asset, sorry to interrupt you, are those single asset junior miners? So that's not like a mid-tier miner, like say an Alamos Gold or an IM Gold or Kinross, that says like, okay, we have like 5 producing mines, we're going to bring our next mine online. It's not like that.
Right. I'm talking about single non-producers, just pure developers, right? Single asset, or they have multiple assets, but they haven't built a mine yet. I'm just talking about developers. But you are correct. The mid tiers and the majors, they probably, but again, it's not easy to get to a construction ready decision. But of those, they probably could fast track. If gold went to $2,700, they probably could fast track another 10 mines. So maybe you could get 20 mines into construction within 24 months. Something like that. But it's not as if there's a whole bunch of mines out there that are ready to go. Usually you only get, on an annual basis, you only usually get 1 new silver mine a year, and you only get about 3 new gold mines. But I'm talking about single projects, not necessarily existing producers. With existing producers, it's probably double that. It's probably 6, maybe 10. But a lot of those projects are like extensions of existing mines. They're not new mines. They take a new pit and then bring it online, kind of thing.
Yeah, or it's a partnership deal. So now you're seeing like in Osisko Mining in Quebec, they went and did a 50% joint venture deal with Goldfields because they didn't want to take on all debt and equity financing all by themselves with the cost of capital this high. I think the case study here for our listeners out there is that Argonaut Gold, they tried to do everything alone on Mangino, and then there were problems at the mine. The mine was not on time and on budget. And then the management team ended up having to sell Mangino for pennies on the dollar to the neighbor next door, Alamos Gold. And Alamos Gold, the mid-tier, got to pick up this asset for literally pennies on the dollar.
Let's talk about problem childs, right? So we got SSR Mining, we got Victoria, and now we have Argonaut. So Argonaut's the worst of the bunch. They screwed up that mine so badly. Argonaut had been a producer for 10 years. They knew how to build and develop mines, but they always built small mines. They never built a large one. So what they did wrong was they didn't bring in a new CEO. It's like the old CEO, yeah, he could handle small mines. When I say small mines, I'm talking about 100,000 ounces a year, $200 million capex. But this was a 300,000 ounce of mine and $1 billion capex. Basically, it was too big for the CEO. The board screwed this up. They screwed the shareholders. Yeah, and this is the thing. It is a tough business, and it's really, really difficult to build and operate mines. And Argonaut, yeah, they bit off too much as they could chew, and they basically, yeah, they just recently sold the rest of their mines.
Well, Alamos, I think the beneficiaries are Alamos Gold shareholders, right? Because they got the asset. They
And
only
he,
have to spend a fraction of the capex, right, to fix the asset.
yes, yes, yeah. Heliostar was the other big beneficiary. They got their Mexico mines, and then they just sold the Florida Canyon mine to Integra. So yeah, they're the gift that keeps giving, right? They made three companies. Integra improved dramatically from picking up that Florida Canyon mine from Argonaut because Integra was a long-term development play. Remember, I tell you, it takes forever to get these things construction ready. Integra was probably 3 years away. And now they're a producer. So complete game changer for Integra. Heliostar, complete game changer for them. And Alamos, they're the gift that kept giving. Now let's talk about the other two problem childs. SSR Mining, that was something that, they screwed that up as well. They basically, their heap leach pad was built on a hill. People knew it was dangerous. They really screwed that one up. That was another management mistake. You were telling me, hopefully this is, I should, as I'm going to produce this, do you think, say this, do you think it's a 50-50 chance
that's what I heard from a couple different sources, that it's at best, they have a $300 million environmental damage reclamation fee. So they have to fix the remediation at the mine, clean up the mine, fix some of the heap leach pad issues. They have to pay out lawsuits for wrongful death and things like that. So they have to pay the bill first, 300 million, and then it's still 50-50 if the Turkish government gives them the permits to restart the mine. The major problem, if you run the numbers with SSR, is that the stock is super cheap on evaluation. I think it's the cheapest mid-tier gold miner right now on a net asset value, but that's because Choppler, which is the mine in issue, that's 40% of their annual cash flows. So if Choppler doesn't restart, I mean, they're going to have some balance sheet issues in the next couple of years, especially if that $300 million remediation fee is not paid back with cash flow.
Yeah, you're right. I have it printed as a 9-bagger at $3,000 gold, trading at a 4 multiple right now. So yeah,
well, that's assuming the company isn't, bought and chopped up or something by multiple companies. I mean, I could see if the assets stay that cheap and gold prices stay this high or go higher, I could see a mid-tier gold miner or copper miner wanting to go in there and buy the assets, like a Lundin Mining or a Lundin Gold. I could see both Lundin companies wanting to go in there and divide up the assets.
Yeah, my 9-bagger is based on Koppler restarting. So if it doesn't restart, then yeah, it's back to kind of a maybe not a cheap. It's no longer a cheap mid-tier.
Yeah, so the market doesn't, for listeners out there, the market does not like that type of uncertainty because literally it's a coin flip now. So you have this large bill, $300 million, and the mining company might pay it, and then they might not be able to restart the mine anyway. So the market doesn't like that type of uncertainty, and that's why the market, the discounts are that high on the valuation for the shares.
Right. Yep. Absolutely. Yeah. Right now, we're kind of in a wait and see mode. I think this is really a stock that you don't really want to buy it here. You have to decide if you want to hold it, but I don't think it's a stock you want to buy. You want to, because of the uncertainty, you want to wait and see what the outcome is. Because it was a $300 million cost. Now, I don't know if that's just, if that's a cleanup or if the cleanup's on top of it. But it's a lot of money.
Well, they've itemized it. If you go to their website and their investor presentation and their Q2 earnings, I mean, they said that like there's lawsuits in there for settling like the wrongful death of the 9 people's lives that were lost in the accident, and then also the environmental damage fees from the Turkish government, and then they have to invest in reclamation at the mine site. So that's a mix. They have the cost like kind of itemized, and that's the estimate now. But I mean, the estimate could change, and so they could pay, like I said, they could pay that 300 million, and the bill could be more, or they
Right.
still might not get the permits to restart mining.
Right. If it's only 300 million and they restart the mine, it's going to be a win for them. Let's just cross our fingers that's the outcome. All right, let's go to Victoria. So Victoria was totally unexpected. Maybe there was a engineer or two that thought it was risky, but I think that one was a bit of a shocker.
So for listeners out there, that mine, what it's up in Canada, it's up in the Yukon, and it's a heap leach operation. It's an open pit.
Yes. Yeah, open pit up in the Yukon. So this is a mine. Yeah, you really you got to wait on the sidelines on this one. As a matter of fact, I think they're done. I don't think they recover from this.
Well,
The reason why I say that, you had a comment?
oh, I was going to say, did you see in the press releases, like the last sentence of their press release the last month or so has been that their creditors are calling in their loans. So I would say they're probably done unless their creditors, they can get their creditors to not call in the loans immediately. But it said their creditors have notified them that they're in breach of their loans and that they're going to default soon.
Right. Yeah, and the reason why the creditors do that, and the reason why they have that as part of their contract, the loan contract, is because if they don't call in the loan, then they can basically the other people can basically get hold of a lot of the value of the company. In other words, all the cash that they currently have, they could basically burn through it, and then then they could be paying additional people like contractors or whatever. And so the bank wants to get as much money as they possibly can get back. So they want to go to the head of line and basically shut it all down. And so yeah, so I wouldn't be surprised if we hear an announcement this month that they're in administration. It's pretty much over, and then the banker is going to go and sell it to somebody else.
Yeah, that's what I was going to say. So I think they also have a construction loan from Caterpillar for some of the mining equipment out that they haven't fully paid back yet from when the mine was built in like 2018 or 2019. It was a very, very large amount of money that they borrowed, I think, from Caterpillar as well. So for what Don's describing, it's senior secured creditors. So they're at the front of the line. So if they want, they can force asset sales. So that's probably why they said that they're calling in the loan now, because they know that they're senior secured creditors at the front of the line in the capital structure. So they can force the mining company, said draining all the cash and assets, they can force an asset sale to, say, a larger miner if they think that the mine can maybe eventually be turned around or restarted with permitting in the future. But that looks at an issue too, because I think a major theme here we're starting to see now, Don, whether it's the Yukon now with this heap leach pad accident and then the problem at Victoria Gold, their mine, is that a lot of these open pit copper and gold mines with heap leach pads, it seems that the politicians now, if there's a mining accident or not, especially in Latin America, they're starting to deny permits for a lot of these open pit copper and gold mines going forward.
I know it's definitely a trend. It's Mexico hasn't approved an open pit mine since AMLO got into office 2017, 6 years. So it's been 6 years without any approval. Now I've talked to a few people that have mines in Mexico, and they're bullish. They think that Sheinbaum is going to be open for business, and that she's not going to shut down open pit mining, and she's going to allow new open pit mines. So we're going to find out in Q4, because one example is Silver Tiger, who's had their permits in for their open pit mine. And now their open pit mine is a little different because they already have a permit for underground mining. So it's an add-on. And so sometimes they treat those a little easier. So that might not tell us a complete green light if Silver Tiger does get their open pit. But if Silver Tiger doesn't get their open pit in Q4, that's going to be a bad sign, a bad tell, if you will. The other one is Minera Alamos, who's trying to permit an open pit mine this year. And so if they don't get theirs, then the other big one is Discovery. They're going to submit theirs, but they're not expecting theirs this year, but they're expecting it next year. So over the next 12 months, we're going to find out, as far as Mexico goes, how anti-open pit mining they are. And then, yeah, some of these other countries, Ecuador, Colombia, Argentina, Peru, Chile, they might be a little more apprehensive about open pit mines.
The other big one, Don, is Cobre Panama in Panama. I mean, like that has stopped all investment in the country. So for mining, and they have a lot of potential for a lot of copper and gold mines too. And that I think that copper and gold mine from First Quantum, Cobre Panama mine was so large. I think it was over 1% of the annual copper production globally.
Yeah, it was huge. I expect that mine to come back online. The new president he's more of a pro mining, but he he found that it's not so easy. What he did was he requested a review, an environmental review, and that's happening right now as we speak. So he's trying to get it overturned, but he's doing it in a political way. So he's starting off with he's starting off to prove that environmentally it's not dangerous or it's not bad for the environment. That'll be step one, and then he'll have to see if he can get the community behind it. And yeah, so we'll see what happens. But I expect that mine to come back online. But overall, yeah, it's risky to invest in gold and silver mines. I say that every single one is a speculation because you cannot think of any gold silver mine as a sure thing. Some things can go south for a number of reasons, and now you have your location risk on top of that. So we have Central America, South America, and then Africa. Those are kind of the three regions that have kind of the most gold that where investors really want to invest, but the risk level increases. I invest in all three of those regions, but I try to diversify, especially you can diversify into ETFs, you can diversify into physical, and then I like Australia a lot. I've been buying a lot of miners in Australia because I think Australia is kind of mining is kind of in their DNA. It's mining in Australia is like farming in the U.S., Canada as well. Canada, they have had some issues, some native issues there, but overall, I think that Canada is a pro-mining nation. Another place is I like Alaska a lot. I think Alaska is going to be a pro-mining area. I actually think Pebble's even going to get built.
Oh, really?
Yes. The governor of Alaska is suing the EPA right now. I think they're going to kick the EPA out of Alaska, saying, "Go home. We don't need you." I think that's going to be.
We'll see. I mean, that Pebble mine, I mean, that's one that the environmentalists, lawyers, the lobbyists, the green energy people, they fight that one more than seems any other mine in the U.S.
Right. From the lower 50. The Alaskans want it. There's no environmentalists in Alaska fighting it. They're all lower 50 people.
Well, yeah, that's how things work here in Washington, D.C., man. That's how, like, you're at a non-governmental organization here and you're making like 80,000 to 130,000 a year doing almost nothing. So, I mean, like, it's all connected to the energy spending grift.
Right. So, yeah, I do. I think Pebble will get built, and not because Washington wants it. It's going to be because Alaska wants it. It's going to be really interesting to see what happens politically the rest of the decade. But I don't own Pebble. I don't own the shares.
Yeah, I mean, I don't think it's a good bet here because there's so much money for lobbying against it. I would be surprised if it gets built in the next 10 years, but we'll see. So we'll see what happens going forward. I want to ask you though, so what you described in the last couple of minutes with problems with getting permits, even if they're delayed. So even if Mexico, even if they do approve like these open pit mining, you think it could take years longer, the cost could be a lot higher. It sounds like there's going to be supply issues for copper and silver in a lot of the major areas that produce a lot of copper and silver, like Chile, Mexico, Panama, Peru. Do you agree with that?
Yeah, I do. So the company is Northern Dynasty. I don't think it's a good bet. I don't own the stock. And you're right. It might not get built for the next 10 years, but it has 80 billion pounds of copper. So you talk.
Oh yeah, doesn't it have like 40 or 50 million ounces? The numbers are like insane.
75 million ounces of gold. It's the biggest undeveloped mine in the world. And so, you talk about jobs. I mean, this thing is huge. It's going to create unbelievable number of jobs. So yeah, but you talk about shortages, right? There's not enough silver, there's not enough copper, and you got this mine that's construction ready. Build the thing, right? So, but you're right. There's not enough copper to go around. The only thing that's going to save us from, you know, copper prices, basically shortages, if you will, is there's going to have to be some type of a new energy, something invented, because there's definitely not enough copper to do with what we want under our current infrastructure. The way the current infrastructure works in the U.S. and Western Europe, if you try to extend that to India, Africa, Central and South America, there's not enough copper. There just flat out isn't. And that's why a lot of people are very, very bullish copper, because they're just doing the math and there's like shortages. They are coming, they're coming, they're coming. And I also think that you mentioned the open pit problems, like down in Peru and Chile, which mine most of the copper, and they don't want these massive open pits. They shut down. There was a glacier. There was a huge mine that Barrick was building, and they didn't give them the permit. That one's off the table right now. So you can't. They wouldn't let them permit that one. So there's been some big
Are
copper
you
mines
talking
that
about Pascua-Lama?
yeah, yeah. And so that one was, I mean, it was a big gold mine, but it also had a lot of copper, and that one got shut down. And I don't think they probably won't even go back there. But there's going to, my point is there's going to be additional big copper mines that don't get permitted, like you said, and the one that's in Panama right now that's offline. So here we are, we don't have enough copper, and it's getting harder to permit these large open pit copper mines. Um,
Also, the
but
banks, let me add to your points there, Don. Also, I think a lot of the banks, the regular, so large European banks, US banks, they don't want to fund these copper mines. So they don't want to give a copper miner or gold miner billions of dollars to go and build a copper mine, because then the ESG people on their board are angry that they're funding fossil fuel usage, electricity usage, and mining.
And there's additional risk. The additional risk is the natives don't want the open pits, and then that's what happened in Panama. So you fund it, and then the thing gets shut down. There's that risk as well. So there's additional risks. So and the other risk, I think, for copper mining, and this is the reason why I've basically have hesitated to invest in gold copper projects, is I think that the U.S. economy is going to hit a wall. And the U.S. economy is 25% of global GDP. And so if the U.S. economy hits a wall, and I'm not saying it's going to crash, I'm saying it's going to stop growing, kind of be like Europe. But it's going to be, if that happens, you're going to have a lot of liquidity problems. So bankers, like, New York is the banking capital of the world. I mean, they fund a lot of these mines. And so if the economy slows to a halt, stops growing, you're going to have liquidity issues where banks, it's going to be harder to raise money. And so these copper mines, most of them have $1 billion capex. Some of them have $5 billion capex. So those are going to be really hard to fund if everything slows. And then on top of that, if the U.S. is kind of like in a quasi recession where it's not growing, that's going to slow down international GDP, international growth, and that will slow down demand for copper. So I'm bullish on the price of copper, but I'm not bullish on the demand for copper, unless it's going to be interesting to see what happens if the U.S. economy can get back on its feet again and kind of be the engine for the world and get the growth going. So I'm not like a lot of people are really, really bullish on copper because what we were talking about the supply issues. But I think there's going to be demand issues that kind of offset that. But and it could happen in silver as well. But I'm hoping with silver, the investor community soaks up all of that excess supply, whereas the demand slows for like solar panels and cars, but investors offset it. That's my fingers crossed scenario.
Well, didn't India just import more silver in the first like 4 or 5 months of this year than it did for all of 2023? So there's signs that industrial demand and retail investor demand for silver in Asia, so China, India, Japan, Korea, Thailand, Vietnam, the demand for gold and silver is very strong in those countries.
Oh, absolutely. But that's because the economy, the world economy is still normal, if you will. It's everything is still, the skids are still greased. We're still, I mean, copper panel growth is still there. We're seeing the growth in electric cars is still there, and we're still seeing that. So, yeah, supply demand for silver is off the charts. I mean, we're going to have a deficit this year of over 150 million ounces. The last 3 years, it's been over 100 million ounces. So the supply of 1,000 ounce bars inventory, I think, is low. I think it's less than 50 million ounces. So we could run out of 1,000 ounce bars fairly quickly with silver, which I'm hoping happens. I'm hoping the retail crowd will soak it all up. But if I'm right about the U.S. economy basically hitting a wall, I think that demand for copper, I mean, for solar panels is gonna shrink as well, and it's going to take investor demand to really push the price higher.
Well, we'll see because I would argue for on the copper side, it depends on big tech. So, like the companies like Amazon and Microsoft and Google and Meta, whether they actually spend the capex to build the next generation data centers, because they're talking about spending.
Right.
Amazon alone's talking about spending $150 billion in capital expenditure building data centers over the next 5 to 10 years, like an insane amount of capital expenditure to build these next generation data centers. They're going to use an insane amount of electricity, a lot of copper wiring, all those things. So we'll
Right.
see. So right now they haven't started building these data centers yet, but over the next couple of years they're going to start construction on these things.
Oh, they've started and they're going to continue. Absolutely, they're building data centers all over the place, and
Well,
I agree.
those are smaller. So those data centers, I think, are the last generation ones. A lot of those are not the next generation ones. So those aren't the ones for raw computing power for artificial intelligence. Those are the ones for like for Netflix and YouTube. So those are like the ones near major cities and metro areas that are focused on like broadband and latency. The next
Right.
generation ones, we're talking, they're going to use an order of magnitude more electricity, Don. It's nuts.
I I absolutely agree with you completely. That's why I'm saying there's the current copper supply and production will there won't be enough if, again, this is the big if, the economy basically continues in its current form. In other words, I mean, if you look at US GDP today, and if the GDP keeps growing at even at 1%, if it just keep, and then the rest of the world, if everything just continues on the path. So we've basically been on this technology materialistic path since after the World War II. After World War II started, it's just been a steady expansion of technology, which really, culminated in the 80s and the 90s, and it just kept going after that. If that continues, if we continue on that trend, absolutely, there's not going to be enough copper. Copper could go to $15 a pound, easy, and I expect copper to go to 7 to 8, even if demand slows. I'm expecting demand to slow on copper because like I said, I think that the U.S. economy is going to hit a wall here because I think the debt bubble is going to pop. And I think I'm hearing popping sounds right now, if you will. If the debt bubble pops in the U.S. bond market, the key to it all, believe it or not, I mean, if you really want to know what's going to drive the copper price, it's the U.S. bond market. If the U.S. bond market can continue to borrow whatever it needs and keep expanding that debt bubble and keep everything together, yeah, copper, we're not going to have enough copper. We just won't. And copper is going to go north of $10 a pound. But if that bubble starts to pop and demand starts to slow, I think 7, 8, $9 is as high as it will go. But and then of course you could have hyperinflation, which could push it even higher. But my target is just $7, $8, 25, 26, 27 is where I'm seeing it. But if the
I
economy
think
is
that's
growing,
reasonable. Yeah, I think those are reasonable because I think the trend here is very similar for gold and silver and more so for copper is falling ore grades, rising cost of capital to build a copper mine, the input cost to maintain the copper mine, to build the copper mine, all these costs are trending up. I mean, I don't see costs going down enormously across the board, especially for copper, because the ore grades have collapsed. I mean, we're below most copper mines now, below 1 gram per ton copper now.
yeah, the new mines are, oh my gosh, they're huge. They cost a boatload of money. They take a long time to build too. I mean, 2-year, 3-year builds on some of these things. So it's not like copper is going to come online quickly. So once you get a shortage, it's going to take a year or two to close that down. So that's my hope. Now, one of the things that I'm expecting is a shortage in silver in the near term, like say the next 6 months, because once silver gets above $35, and this is basically your risk off fear trade. But once it gets above $35, silver becomes a proxy for gold. So as the wealthy and start investing in gold, the people that cannot afford $2,000 for an ounce of, now it's $2,400 for an ounce of gold, they're going to buy silver as a substitute, as a proxy. And if people start buying silver, it won't take much. Silver is a very small, I mean, if you look at a dollar basis, the amount of silver out there is just, it's tiny. I mean, when you just do it on billions of dollars, you can soak up supply really, really fast. And so I think in the next 6 months, you could see a shortage in silver. Now, how the shortage would unfold is the wholesale market, the retail market would basically empty your shelves. So the first place to go would be your local coin dealer. All the local coin dealers would be out. Like if you lived in the LA region and you tried to find a coin shop that had silver, you wouldn't find one. They'd be out. It'd be gone. And then the next thing you would do, you go online. So basically your local coin shops, they're going to get wiped out first. And then everybody will go online. And once AppMex is out, they'll all be out. And so the retail could be wiped out in a month. And it'd be gone. And then once that happens, all your refiners to restock their 10-ounce and 5-ounce bars, they buy from the wholesalers and they buy 1,000-ounce bars. Those 1,000-ounce bars are who the fabricators buy from. So that now you have basically your retail investors taking away silver supply from the fabricators. That's where you have your shortage. So it'll start at the retail level, and then once it hits wholesale, all you will need is one large corporation, such as Apple or Sony, basically saying, we got to shut down, our phones. We can't make any phones because our supplier can't get any silver. All it will take is one news release that they shut down because they can't find silver, and silver, you have a shortage. Boom, it happens. And I think that's going to happen in the next 6 months if you get above $35 silver.
That's interesting. I mean, I would argue that some of that has already started to play out, and that's why we have higher gold and silver prices, not just because central banks outside the G7 are dollar cost averaging gold tonnage. There's been a huge retail investment demand spike for gold and silver in China, India, Japan, Korea, Thailand, Vietnam since October. Just record amounts of retail demand for gold and silver, and that's what has caused a lot of this rally in price, especially for gold, but also for silver. Over the last 9 or 10 months.
Yeah, I'm glad you do your homework. That's absolutely true. It's actually already starting. And there was a solar panel, Chinese solar panel company that took delivery on the COMEX. They didn't take delivery in China. They took delivery on the COMEX of over 100 million ounces. It's
wow.
100 million ounces of solar company.
Was that for the world's largest? Didn't they just, you might know more about this. Didn't China just bring online the world's largest solar farm right near the Gobi Desert? I think they just brought online the last month or two.
I haven't heard about that, but I know that their solar panel production is basically being gone through the roof. It's like 200 million ounces now for solar panels. I mean, it's getting really, really crazy. But yeah, this company that took the 100 million ounces of silver, they were the largest solar panel producer, and they wanted inventory. They basically just bought it for inventory. I'm not sure why they bought it in the U.S. and not in China. I think maybe they got a cheaper price in the U.S. They want to save some money. But
No idea. I mean, like normally the bullion banks would make them jump through a bunch of hoops. They'd like that type of delivery demand. They'd make them sometimes wait 6 to 12 months in the past. They'd say, "Oh, are you sure you want delivery of that much metal? Or you're gonna have to wait 12 months or 6 months or 12 months, something like that." I mean, I've heard stories. I had a money manager friend back in like 2010 or 11. He took delivery on the COMEX of 1 ton of physical silver on a futures contract, and I think they made him wait 6 months, even though they claimed they had plenty of silver in the vault. They still screwed him over for 6 months and made him jump through all these hoops and sign all these insurance waivers and all these extra delivery fees.
that 6 months, that's crazy. That just tells me they didn't have the inventory.
Well, they get away, Don. They get away with it. I mean, David Morgan, our mutual friend David Morgan at Silver Investor, the Silver Guru. I mean, he's compared the Comex. He basically says it's a showroom. So he says that like, oh, you see your gold or silver on a futures contract, and it doesn't like the numbers that they say we have an inventory for the exchanges. That doesn't mean anything because if you're a small money manager, or retail investor, or someone high net worth, and you want to take delivery of a futures contract, they're going to tell you like, well, you're at the back of the line. You're not a priority customer.
Right. Um, Now, China has been known for creating big inventories um, of base metals. So if silver even starts to hint at shortages because they make, so much electronics in China. So if silver even starts to hint at a shortage, China is going to just start hoarding it. They're going to basically buy some commercial, storage units and just start putting pallets of 1,000 ounce bars. And those bars aren't for sale. They're taken off the market. So yeah, what you're saying is absolutely true that it's already started. And so, like I said, you want once like I said, once the retail is empty, one clue that it started is somebody tweeted on Twitter that you couldn't find silver in Tokyo. He wasn't Japanese. I think he was he was a foreigner and he was visiting there and he was going to all the coin shops and trying to find silver and he couldn't find any in Tokyo. Tokyo is a big city.
Well, I think the gold price in Japanese yen isn't it up like 150% in the last 5 years?
Yeah,
It's up enormously.
yeah, yeah. So the Japanese, they're definitely stacking over there. That's the reason why they don't have any. A city of that size, all you need is a few rich guys, right? To basically stack. If they're buying, I don't know, 1,000 ounces a month, it doesn't take much to empty out these local coin shops. And they basically, as soon as the inventory, the only thing these guys they can't keep it in inventory. So all they can do is order it for their customers. And
Well, if
I've seen that at coin shops where you go into a coin shop and they're out, but they're like, we'll order it for you. That's about all they can do, but they can't keep it in stock.
Well, I mean, the premiums are low in the US for a lot of gold and silver products. There's been a lot of net selling. A-Mark just disclosed, which is publicly traded. They're a wholesale and retail bullion dealer here in the US and Canada. And they just disclosed that their sales for retail investors for gold and silver are down a lot here in the US and premiums have come down. But in Japan, though, I think they changed the tax laws, if I remember correctly, back in January to where in people's retirement accounts for high net worth in Japan, I think like they're allowed to put at least 100,000 of physical gold into their retirement account for tax free, I think.
That's one of the reasons you can't find it there. Now, I totally agree with you that right now there's plenty of supply. Your local coin shop, he has silver right now. As a
Well, in
matter
the US and Canada, but I think like in China, the premiums like
of,
weren't the premiums in December, January in China, they were $6 an ounce for silver, I think above the spot price. So there was a ton of metal leaving like the US and New York and retail investors and
yeah,
flowing to the east.
yeah. Silver's been above 10% all year, and it's gotten as high as almost 20%. I saw 17%. So yeah, the silver premiums have been high in China. You haven't been able to get below 10% there. But you're right. It's interesting. So there's strong retail demand in Asia for silver, not so much in the US, not so much in Europe, not so much in Canada. And the reason why is because the consumer is kind of strapped, the average consumer. So Yeah, there
Well,
hasn't
well,
been
also, well,
demand right.
that's the inflation, but also like in Asia, you have weaker currencies against the dollar, so people in Asia are more likely to accumulate metal if they're worried about a currency crisis or inflation, and so
Yeah,
they're more inherent to save in metal outside the banking system, especially in China, given like the history of paper
right,
money collapse and silver standards in China, because
right.
they invented paper money in China for our listeners out there. So I think we're seeing weaker Asian currencies against the dollar, and I think like those people in Asia, that's why demand is so strong in a lot of Asian countries.
Right. It's also part of their culture. Their culture is, it's normal to be a gold stacker. It's very normal. Where here in the US, it's not as normal, especially for affluent people. They're like, no, no, we don't. It's considered, in some respects, it's considered un-American. Like, you're not supposed to do that. What, you don't believe in the dollar?
That's not what the Constitution says. I mean, people have been brainwashed for 100 something years of Keynesian economics and other brainwashing to go away from that because the Constitution, right, it only had gold and silver as legal tender. So
Right, but most of like Wall Street, I mean, if you ask like analysts or CEOs, do you stack physical, gold or silver, most of them, the answer is no. It's not something.
Well, let me just tell you that some of the stuff you hear on business television might not be true because I've definitely seen people that go on TV and bash gold and silver on business TV on CNBC or Bloomberg because they talk up stocks, but then like off the record when they're drinking at like a cocktail party or something or talking to me on a podcast off the record or emails or something like that, they'll say that like they have a whole safe full of gold and silver bars and they have guns and stuff like that, but they say like, oh, none of my hedge fund investor money is invested in gold and silver, but I own Bitcoin, I own gold and silver, guns and ammo.
That's great. But I think they are the exception. The average person in the US, it's still considered um, somewhat, uh, I don't know what the right word is, but
Taboo
it's
now to buy gold and silver to accumulate it. It's looked at like, oh, you can't find something that's paying a dividend or it's a tech stock or you're going to get rich quick on Bitcoin or crypto or something. So like the mentality here is what FOMO, fear of missing out or was it no, well, FOMO is the main one. Oh,
right.
YOLO, you only live once, but FOMO or
Yeah,
YOLO. So the mentality is here, get rich quick, and you can't do that on gold and silver. It's just saving over long periods of time.
right. It's just in the US, it's somewhat it's like you're a pessimist for the US economy. You're betting against it, kind of thing. You're not patriotic, and that guy over there. Yeah, he's just uh, like a prepper. He stacks silver.
Well, then the PhD economists in academia and the federal government, big government, have done a good job then of brainwashing people over the last 100 or so years because they've convinced people that like saving outside of fiat currencies is not a good idea.
Yeah, you're absolutely right. Couldn't agree more. It's kind of a brainwashing thing.
Yep,
Um,
well, that's what Keynesian economics is, but we don't have time to discuss that on this podcast.
right. That's another hour.
So, as we wrap up here, Don, would you say that there would be major supply constraints for copper, gold, and silver going forward because of cost of capital, using debt to build a mine, and then also a lot of these Wall Street analysts that work for the banks that might fund some of these projects? Do you think that they have lower metals price targets, so that also is preventing funding for new mines?
Um, well, the first question is, are we going to have supply constraints? We talked about this yesterday for copper. Absolutely. There's not. We mentioned this. The economy remains the same. There's not going to be enough copper. I don't know when the shortages begin, but they're going to come in a vengeance. Absolutely. But as far as gold and silver miners go, as far as funding goes, it is right now. It is really, really difficult to fund capex for new mines. Very difficult to raise money for financings for advancing projects. Exploration and development is really difficult. Like Maritime, they couldn't borrow any money. They just had to do a really nasty 30% financing, raise $8 million when they're really close to production. But I'm seeing a lot of really ugly financings with full warrants. when you normally wouldn't see full warrants, you'd see half warrants. Going, what the heck? Why are they doing a full warrant? I think Lion One, who's a producer, they couldn't borrow any money. They had to do a financing with a full warrant. That was ugly. So it's tough right now. And I think that will slow down a lot of development and exploration. Even when gold and silver prices go up, it's going to get harder and harder. I don't think financing is going to get easier. So we're going to probably see a lot of ugly M&A deals. So this is where like me, I own a lot of stocks, so it's probably going to be beneficial for me because I'm going to be eating up all these companies. All the mid-tier producers are going to be eating up a lot of these developers because the developers, they can't get funding, they can't finance it, or it's really ugly, and it's going to make more sense for them to sell. But I do think that a lot of the exploration plays, they should hold out. They shouldn't sell, or they should wait for the M&A to kick in so they don't give away their companies. But because if you're an exploration company, just keeping the lights on doesn't cost a lot of money. You can wait. You don't have to drill real aggressively. You can just kind of, if you have a project, but if you don't have one, you're trying to raise money, that's going to be a pain. But the developers, I think, are probably the ones that are kind of behind the eight ball here, because it costs a lot of money to get to construction ready. Then it costs a lot of money to CapEx these things. The CapEx that went up. A lot of these development stories, like I said, they're probably, if they can't finance these mines, how long can they wait? And they're probably going to have to sell, and their shareholders are going to get screwed. So that's because the lack of money. The opposite of that, the other side of the coin there is if you're a producer like Silvercrest Metals and you have a clean balance sheet, you have no debt, and you have $100 million in cash, you're ready to go and build another mine. So it's like, and if you go out and make an offer to somebody else, and you're probably going to be able to pick up some projects for good deals. And so the
Yeah, I
company,
agree. It's a buyer's market still, despite the metals prices, because I think one of the major issues here is because of interest rates, the Fed raising interest rates so quickly, the cost of capital for a miner, especially not a miner that doesn't already have producing mines, the cost of capital is just so high, especially if you're trying to use debt to build a mine. It's just not feasible to use all debt to build a mine right now.
And like one final point on as far as funding and banking goes, I've always been a believer in mining industry of being cash focused. And basically what I want to see is I want to see a company with over $100 million in cash and no debt. And it gives you so much leverage. Like I really never liked it when First Majestic, because at one time First Majestic didn't have any debt, and now they have, I think, 175 million. And well, they say, well, none of it's due until 2027, but still you have it, so that reduces your leverage. Like if they didn't have any debt right now, they could go out and acquire somebody like they had, because they have a lot of cash. So if you have cash and you don't have debt, you can do acquisitions. It's a lot harder to do an acquisition when you have debt on your balance sheet, because whoever you acquire, you're probably going to have to spend money to build any mine you acquire. It's probably not going to be just a clean acquisition of producer. But it could be. But I just like cash focus. Like Westgold in Australia, I really like their CEO. I talked to him. I said, I really like your strategy, because they have like, now I think they have like $200 million in cash and no debt. And I was like, and I really like that strategy. And he goes, we're going to continue it. I'm going, that's great, because there's not a lot of CEOs out there that really recognize the advantages of having a cash-focused business. Like Coeur Mining. We didn't really talk a lot about. I was going to talk about it, and all the poor. We didn't get to it. There's a lot of this quarter. There was really a lot of poor quarters. Coeur was one of them. Their costs were really high, and they lost money, and we don't want to see that. But Coeur and Hecla are two companies that have always had a lot of debt on their balance sheet, and they think that that's normal. And I'm like, you need build a mine, pay it off, build cash. And the irony is that both of those companies are aggressive companies who like to do acquisitions. And the best way to do acquisitions with a cash focused balance sheet. So hopefully we'll see more companies that adopt that strategy because it's harder to raise money. Because if you have a lot of cash in your balance sheet, you can borrow. All you have to do is have restrictive cash. Say, okay, if you have, let's say you have $200 million in your balance sheet, we'll restrict 100 million and let us borrow 125 or 150. And banks will do that as long as you keep the restrictive cash as collateral. So
Well,
we'll
the track record of those miners, I mean, like they're higher costs go up, and then like a lot of them have done bad acquisitions. So they might do a good acquisition here or there, but they have a long track record of doing bad acquisitions. You've been covering the gold and silver miners, Don, for so long. You know the history. They do a bad acquisition, they do a reverse stock split, they do share dilution, they repeat on the
yeah,
next acquisition. Here we go.
yeah,
So that's why I prefer over a long period of time. I just prefer buying and holding the precious metal royalty and streaming companies like a Wheaton Precious Metals. I mean, my cost basis is between $11 and $15 a share. I bought my shares over a decade ago and I've just held them. And the business grew and they paid off the debt. They used the debt smartly to go buy royalties and streams, and the business grew. They paid off the debt. And now they're growing dividends. So, and then they're reinvesting. So, I mean, that business model is going to be needed for funding future copper mines with gold or silver byproduct.
yeah. Wheaton's my favorite royalty company. It's a thing of beauty. I mean, that thing just generates cash. So yeah, and it's cheap. It's kind of crazy that Wheaton could be cheap, but they actually are. Yeah, Wheaton will probably outperform Newmont. I would expect them to. It's not much, but they're very similar. But you have less risk, right? So you basically get the same performance with less risk. So
Well, better profit margins too. You're not going to get a cost surprise. So that's like the major issue here. So yeah, a mine could come offline with a royalty or stream like Franco-Nevada, Cobre Panama. I think that was a buying opportunity. Franco-Nevada around $110 a share. I haven't looked at it in the last week, but I think it was up to like 130 recently. Let me see here. Pull it up real quick. It got up to one. Let's see. It's at 121. So it's come down a little bit, but I mean it was at $110 stuck there for many, many months, and then it rallied to 130 until recently. So I think like these businesses, they don't go bankrupt. I mean, Franco doesn't use a bunch of debt, but if they do use debt, they use it strategically, they grow their cash flow, and then they pay off the debt historically.
right. So your strategy basically is a very conservative strategy. Now, would you change your approach if you saw the U.S. bond market basically starting to crack and the debt bubble starting to crack, and you saw that basically gold's going to the moon, and if gold goes to the moon, silver's going to the moon too. If that scenario played out, would you kind of open up your conservative thinking?
I have some optionality stuff, but what worries me though is like windfall profits taxes. So if you invest in one of the mining shares directly, so if you're owning like a senior or mid-tier precious metal royalty and streaming company, they tend to focus more on some type of diversification there. You do get optionality though. So if the juniors start to drill and they have a discovery, some of these royalty and streaming companies, they paid like Franco-Nevada is buying royalties on juniors for 15, 20 million bucks here or there. They're diversifying out. So if there's new discoveries, they're going to have the right of first refusal to go buy a larger gold stream going forward. So I mean there is some optionality there. I don't think most investors understand that. You're getting optionality on large land packages if there is a discovery with the juniors.
Right. Well, what my point was that when I said the U.S. bond market basically breaking, so this is something you're in Washington, and most people in Washington don't even think this way or think this is even possible. But what do you think would happen to the gold and silver price if basically the U.S. Treasury could not borrow what it wants to borrow?
Well, I think the treasury market has almost broke a lot of times in the last 10 or 15 years. And I think there's a ton of shenanigans with accounting fraud, accounting gimmickry, hidden off balance sheet. I mean, I could just give you thousands of stories of like accounting gimmickry. The average person doesn't know this. Even a lot of people that work in finance, like the US federal government uses cash-based accrual accounting, so it's non-GAAP. I mean, that's basically for a private sector company, it's accounting fraud. So
Right.
any other entity using cash-based accrual accounting is accounting fraud. And then there's tons of waste, fraud, tons of waste, fraud, corruption, and systemic abuse throughout all the federal government agencies, the Pentagon, military industrial complex, on and on and on and on and on. We could
Right,
go
right.
here. But I mean, like, okay, the US bond market fails. Honestly, like that's why the Treasury and the Fed got the laws changed during the pandemic and installed legalized special purpose vehicles. So now the Treasury owns the stuff off balance sheet. It's like Enron, man. So, okay, those US Treasury failures that you thought were coming, they already thought about that and they hide the stuff for the collateralized loan obligations and the other mortgage-backed securities, commercial real estate. They can stick all that stuff off balance sheet, no Fed audit. I say no Fed audit, no problem. As long as there's no Fed audits, they can get away with all this stuff.
Right, but they have to, let's say right now we're at a $2 trillion deficit. So we're at 2 trillion, and let's say that we go into a recession here in the next 6 months. That happens, the deficit's not going to go down. So let's say we're kind of in a permanent $2 trillion, 2 trillion plus deficit for the next, say, 24 to 36 months. So they have to borrow $150 billion every single month.
But they count all the government spending as positive towards GDP because the way GDP is calculated is they deflate they don't even use a consumer price index inflation number. They use a deflator and then they count all the government spending is
Right.
counted the same as private sector investment or consumer spending. It's all counted positively towards GDP. So that means the GDP is going to be nominal as long as the government's spending more and more money.
Right. But if they're borrowing, let's say $150 billion a month, and the private sector will only basically come in with 50, so the Fed has to come up with 100 billion every single month. How many months can the Fed do that before people start dumping their bonds? Because if the Fed is stuck buying the bonds like that, all they're doing is just printing money every month, more and more and more. And then people start.
That is a good question. I would argue we've been starting to see that because Japan and China are net sellers of treasuries. They're not buying. The buyers are retail investors outside the United States, and the commercial banking system here in the United States are buyers of the treasuries in size. Those are the major increases.
Yeah, in July, the Fed actually bought $89 billion in bonds, and they're supposed to be QE, but they bought 89 because the Treasury had to borrow 240, I think. And so the Fed has to come in. So the Fed is buying bonds right now. It's already started, but I think it's just going to get worse.
Is this that buyback, that U.S. Treasury buyback plan that they announced with restarts in?
Well, somebody posted it. There's actually the Fed publicly has to show their buys and sells, and it showed in July that they bought 89 billion.
So that's like on top of the bond repurchase program or buyback program that the U.S. Treasury also announced?
I'm not sure exactly where it comes, but all I know is that the Fed actually they added $89 billion in bonds, U.S. bonds to their balance sheet.
And Japan just sold over $100 billion of U.S. Treasuries in the last 3 or 4 months to try to defend their currency. So, I mean, I wonder who ended up buying those treasuries that were sold.
Exactly. It could have been the Fed. That could have been some of their purchases. But it just, this is really my thesis. My thesis is that the debt bubble eventually will pop because the Fed cannot monetize it all. If there's no buyers, it's basically a doom loop. And so, that's the reason why I own gold and silver miners is I just believe that eventually the game's up. You just can't expand debt to infinity. You can do it if you have buyers, but if there's no buyers out there, we've already saw the inflation problem. The inflation, it's already with us. And so the Fed doesn't want to have to monetize all this debt because if they do, then inflation comes back and you get kind of a Weimar type situation. You can't print your way out of it, basically.
Well, or you get stagflation with like financial repression and they let the real inflation rate run hot above the government bond yield. So I think that's like they realize that like the government's not going to be able to cut back on spending. You're starting to see these other central banks cut rates. It looks like they're going to let inflation run hot to try to add liquidity to the system that they're claiming, oh, our inflation rate in Europe is only around 1%. So we're going to start cutting interest rates and then the Fed's going to start cutting interest rates. And then here we are again, they're going to let inflation run hot.
Yeah, I definitely think they're going to let inflation run hot. They're implying that inflation is going to go back to 2%, which I don't expect to happen. And then they cut rates. When they cut rates, it creates an inflationary effect, which nobody's really talking about. But cutting rates actually it actually stimulates the economy, and it can create actually more inflation.
Oh
It's not,
yeah, it adds liquidity to the asset markets, capital markets too. Yeah.
yeah, it's the whole point of higher rates is to create deflation or offset inflation. So when you lower rates, that's why you don't want to lower. It's dangerous to lower rates in an inflationary environment. You want to wait till they're completely gone. Like in the 1980s, when they started lowering rates, it didn't come back and bite them.
Well, I would argue the central bank that PhD economists shouldn't be in charge of raising or lowering interest rates. So, like their textbooks say that if we raise interest rates, we can kill demand and stop inflation. But what they've done is they're actually also killing supply too. So, a lot of mainstream businesses, a lot of commodities
Yes,
businesses, there's
yes,
going to be less supply. So, there's going to be supply
yes,
destruction from the Fed keeping interest rates this high. A lot of less.
yes, yes. I agree. There's been a lot of destruction from these high rates that Wall Street's ignoring. A lot of small businesses have closed
And
because
and and
they couldn't afford the
and
rates.
and then also a lot of commodities projects. So a copper mine, natural gas, liquefied natural gas export facilities, all these types of commodity supply, those projects are delayed or canceled because interest rates are too high. You cannot use debt to build a copper mine that's going to cost many billions of dollars if you're a small producer and that's your first copper mine.
Yeah, absolutely. It doesn't pencil. You're absolutely right. Yep.
Well, Don, I really enjoyed our discussion today. It seems like we've gone way over an hour here. I want to thank you so much for your time. My listeners want to check out your newsletter and your database at Goldstock Data. How did they do so?
Yeah, just on my website, you can basically bounce around and check it out for free. There's a lot of stuff on there for free to see what it offers. So just go to Goldstock Data and just check it out. Click on a few buttons, if you will. There's a lot of stuff there for free. In other words, the whole thing is not behind a paywall. And then, of course, you can follow me on Twitter, Don Durrett, and I'm also on Seeking Alpha as well.
And Don's database is extensive. I mean, he gets awards for this stuff. He has a lot of very good member testimonials. A lot of newsletter writers, I think, also subscribe to his database. He's one of the few ones that keeps like a database like that's kind of like an investment bank. One of these mining stock analysts at an investment bank that would have this thing on like an Excel spreadsheet. Don has that for a retail investor.
Yeah, thank you. That was an excellent testimonial.
Yeah, I mean, you were the first one, I think, to put this database in play. I'm not sure if anyone else has it right now. So most of the other stuff is kind of a newsletter format there. As you know, with the newsletter industry, sometimes there's not proper disclosures for that people were paid for to write up stocks and newsletters with warrants or other share positions.
Yeah, when I first started doing this in the early 2000s, there was a guy named Jason Hommel who had a website, and it was like a forum, and somebody created a spreadsheet of columns, right? It was just a spreadsheet. It had all these columns, all these data points, and that's what gave me the inspiration. It's like somebody needs to create a database with all the data for these miners. So after I wrote my book, I created the website, and it's very, very useful for gold and silver miners. It's really one of the few places you can find data on this stuff. So it's actually a lot of fun, I think, to do research on my website. You can
I've been
spend
doing,
time.
I've been doing this so long. I also know who Jason Hummel is. Yeah, he was one of the early gold and silver stock newsletter writers. Not sure if he's still doing that, but he was. I think even before the 2008 financial crisis, and he was pretty popular for a while.
Yeah, he got out of it a long time ago. He created a coin shop. He did the newsletter, then he did a coin shop, and then he just got out of it. So I think he's on Facebook. I don't like to go on Facebook, but I know he's on Facebook. He's not on Twitter, but he's still around.